Bloomberg Audio Studios. Podcasts, radio, news.
Rieder is BlackRock's CIO of global fixed income and is widely considered to be one of 5 contenders to replace Fed Chair Jay Powell. He writes the following: moving interest rates lower is very much in line with what we do know today, which is that the labour market is clearly slowing to the point of potential stall speed. Rick joins us now for more. Rick, good morning.
Thanks for having me.
It's good to see you, my friend. It's been too long.
Thank you.
Welcome to the studio. Have we got a labour market problem?
I do. And by the way, I don't think it's a cyclical phenomenon. I think there is, or the way Lisa was, I think we have a productivity revolution that is pretty extraordinary. People point to AI as an exclusive driver of that. If you look across what companies are doing, including second quarter earnings, third quarter earnings, if you look at dynamic around how you think about logistics, freight management, predictive maintenance, customer procurement, companies are doing more with less, and I think that is a secular dynamic that's going to be with us for a couple of years now. I mean, we can talk about there's a bit of elevated inflation because of tariffs, but I think we're going to be dealing with something. By the way, you also put robotics, automation. This to me is a structural dynamic. I think full employment will be the challenge for the next couple of years.
So we mentioned the spread between earnings growth, fantastic,
Yep.
Employment growth, terrible.
Yep.
How are we closing that gap, if ever?
So I think, by the way, I actually think that's not a coincidence. Those aren't coincident factors. What's happening is companies literally, the top line revenue is pretty good generally, but what's happening is they're cutting costs of goods sold, they're cutting their SG&A costs, they're reducing their cost infrastructure. By the way, AI is a technology. There's historically been this dynamic of when you have new technology, it moves people into other higher value jobs. This technology, by the way, I put robotics and automation on top of it, autonomous driving, et cetera, is literally designed to replace human input. You have a dynamic that is pretty extraordinary that I think, if, as a central banker or whatever, as you think about being anticipatory of where the world is going, that is where the world is going, and I think that is a challenge. Economy's doing fine, divergent, and quite frankly, only operating on a couple of cylinders. Huge capex, which we talk about from cloud, from infrastructure, from power, and you've got higher income, wealthy savers that are doing great and supporting consumption in the economy. And then you have the part of the economy that's interest rate sensitive, that's really struggling. And that's part of why the interest rate tool needs to address low income, small business, housing. And that's where I think you square the circle.
So we've got to talk about this from 2 perspectives. One as a policymaker, the other as an investor, and one, of course, informs the other. Let's just sit on policy for a moment. You're talking about maybe the need to cut interest rates, but also the fact that some of the pullback we've seen in hiring is not cyclical. How can we address one with lower interest rates? Just explore that for us a little bit more.
Yeah, so first of all, if you came down from Mars and said, okay, so I've got 5-year inflation break-evens that trade in the market, you can buy as many as you want at 2.35%. And you said, okay, now set the price. And you said, okay, 2.35% inflation, and I clearly have a slowing labor market. You would say, gosh, I don't know, if I set the rate at 3, and then I thought about, okay, so now what's equilibrium on the mortgage rate to create velocity in housing? And it directly related to what you said. Housing today is 3/4 of the wealth by people in the country is in housing. We have a housing market that, you look at the earnings from D.R. Horton, you look at Lennar. By the way, I just saw an ISI home builder survey that showed the softness. If you actually get the mortgage rate down a bit, then what happens is all of a sudden you get housing velocity. Why is housing velocity important? Because you get labor mobility. Today you can't move. You lose your job, you got to go somewhere else, you can't move. Secondly, and I've said it before, for every home built in this country, we hire 3.1 people. It's pretty hard to AI building a house. So if you can get some real estate velocity, and by the way, it's where young people who are struggling today, young people who aren't savers, who are borrowers, that's the way they build wealth. That's the way you put people to work. And so I think it is all a related concept. Point being is, and by the way, I mean, if we had to raise interest rates to where they were, but if you said to me today, what's equilibrium? I don't think it's where we sit today in the funds rate.
So how willing are you to allow, or how willing would you be to allow inflation to run above that 2% target in order to run the economy hot to allow for more job creation?
Listen, that's a great question. And I think every time you think about these things, and I think about the same thing, we take risk. You sort of think about what are the quadrants of risk? What are you willing to underwrite? So today, when I think about those quadrants, if you were willing to take some labor and some overall inflation, then you think about, okay, what are the sticky drivers of inflation today? Healthcare, education, insurance. It's pretty hard using the interest rate tool to get insurance costs down. It's pretty hard to get a healthcare. So the tool is not that robust. And health shelter is a sticky part of inflation. That, if I actually get the rate down, I'll actually mitigate some of that elevated. I'll mitigate the rental inflation. So, I'll throw one other thing. 5-year inflation expectations are 2.35%. If you were at 2 3/4, and by the way, core PCE, the 6-month moving average core PCE is 2.5. Let's say we're probably closer to 3 if you take the whole full construct of inflation. 3 is not an infectious. You clearly don't see it in terms of where people anticipate inflation. If you're running 4 or 5, then I'd say, gosh. Or if the 3 was trending higher on things that the interest rate tool impacted, then I think you'd have to address that.
Just to sort of build on that, this idea that 3 is okay, but above that, maybe not so much. There's a feeler that there is an asymmetry in the time frame of AI. That right now the build out is going to be inflationary because of the inflationary inputs of commodity costs, of just how much lending and money this is generating on a broad scale. The productivity gains that will cause disinflation will take a lot longer to come into play. So how, if you were the head of the Fed, would you handle that?
So I take a couple things. So think about historically the way the interest rate tool worked is it was a modulator of capex. So you think about, go back 60s and 70s, the big spenders of manufacturing. Today, my guess is OpenAI, NVIDIA, Google, et cetera, it's not the interest rate tool that is affecting capex. They are going to put that capex in because there is a long run benefit for doing it, meaning the interest rate tool doesn't really do a lot. So I think at the end of the day, does that create a little bit of inflation in the areas you described? I think so, but I think you have to say, where are we going? And I will say, being an investor for a long time, the concept of data dependence, if you were constantly in the rearview mirror trying to figure out how would you invest, is probably the wrong way to do it. We are going through something that's very different. We now are in a capex cycle. And then if you break down the economy and say, okay, what is driving GDP today? That's what's driving this capex and some consumption from higher income people.
The key piece of the inflation story is shelter. You touched on it. And you said something interesting. Interest rates down, shelter costs down. Just explain that for us.
Yeah, so we have an inventory problem in the country. And by the way, you look at every piece of data, it shows the same thing. And so, by the way, when the mortgage rate has come down a bit post this recent Fed drop in interest rates, all of a sudden you're seeing existing home sales pick up. We just saw the prepayment report for mortgages, and all of a sudden you're seeing some acceleration. Meaning you don't have to get the interest rate tool down that much. If you got the mortgage rate into the 5s, I'd say mid to high 5s, you would see some velocity of housing. If you saw velocity of housing today, I saw on D.R. Horton's numbers, they talked about they're doing 1% first year mortgage, and then I think it's 4.9 because they've got to subsidize the mortgage. Well, what if D.R. Horton didn't have to do that? And what if organically the rate was lower? They'd build more houses, you'd create more inventory. You create more inventory, you take the pressure off of rental rates, and you start to bring inflation down. Plus the labor mobility, that is not an insignificant part of that.
Do you think the Fed needs to think outside of the box beyond just interest rates? Is there something else we can do here?
Yeah, I think the Fed has a series of tools. The interest rate tool, by the way, today, nobody really borrows off the overnight funding rate. The interest rate tool, it used to be, you think about how banks borrowed short, they lent long, we had a very different dynamic. Today, the way we tranche the debt in the economy, think about how we finance resi, commercial, asset backs, credit cards, auto loans, it's tranched. The front end of the yield curve doesn't really do a lot. How you think about, where is the 10-year point? How do you think about your balance sheet? How do you think about all the other tools that are at your disposal? I think are really important. Plus, you got to think about what is the effect of the currency, et cetera, relative to that. So anyway, I think the construct is much more complex and much more, quite frankly, you have a lot of tools that create much more effectiveness than we're just going to move the overnight funds rate every 6 weeks.
Like the balance sheet. How much would you be open to see the Fed use the balance sheet a little bit more?
So I think the construct of the balance sheet is important. So I think people don't realize there's a notional dynamic and there's a DV01, there's a duration dynamic further out the yield curve. I am sympathetic to should we keep the balance sheet around the same level? But you could be really effective. So today, the U.S. Treasury, 89% of what the U.S. Treasury finances is at the 0 to 2 year point. 89%. Think about if you're a company, would you ever finance in the 1 year? It's crazy. But that's where we are today, and it is what it is. So there's not that much float actually longer on the curve. There's a reason why people put on steepeners and they get squeezed out of steepeners because there's not that much float. You don't have to use that much balance sheet. But if you thought about, gosh, the construct of the balance sheet, if we used more of it further out the curve, we let runoff happen on the front. If you can keep the stability of the back end. So if you can keep the 10-year we got to the 10-year was 3.90. If the 10-year was 3.5 to 4, stable, and rate volatility came down, all of a sudden you'd see mortgage spreads could come in, then you'd get, and by the way, deregulation of the banking system, then you get mortgage velocity moving. So, by the way, I don't think we're that far away. And by the way, this concept of, we have to get the rate down hundreds of basis points, I just think we're not that far away. Just get it there, keep volatility of the rate market at a stable level, and then you'll see a system that'll operate pretty well.
Rick, you've seen a lot, going back to the late 80s. How much fun are you having right now?
I've said before, this is the best investment environment I've ever seen. Not because stocks are going to go straight up. You have divergence that is great for investing. You have technology that's changing, and so the ability to look at tech stocks, healthcare tech, to look at where some of the financials, how you create velocity in the system, and then the earlier conversation we were talking about the break. Like now, the income levels, as long as this interest rate stays here, which what's ironic is commercially, I'd prefer the interest rate to stay here because this is pretty good. We can create portfolios. We run this ETF called BINC, and creating 6.25. We're running almost 6.30 now. You don't have to take a lot of risk. You don't have to go out the yield curve. That's pretty good. So anyway, I think, and by the way, the options market, I think the best opportunities are in the options market. Rate options, equity options, and you could manage your convexity. So you can be long equities and then buy a lot of, you can overwrite your single name stocks, you can buy downside. It's a fun environment.
Well, let's lean into BINC. You mentioned it, the iShares Flexible Active Income ETF. What kind of things have you been doing over the past 6 months?
We've been, the cool thing about being active is you can move around because the regime shifts. And while I was describing earlier, like, where do you think the interest rate should be? The truth is the interest rate isn't going to move very far. So, we're keeping our interest rate duration, in and around 4 years. We've moved a little bit out of the very front end because it's pricing a lot now in terms of where this Fed is going to go. Then we've shifted some of our credit into mortgages. Quite frankly, if you believe rate volatility is going to be down, mortgages have become interesting, and credit spreads have gotten pretty tight, particularly U.S. investment grade has gotten pretty tight. So we've rotated out of that. We've bought a little bit of EM recently. I would say recently over the last 6 months. We haven't bought EM in a long time. If you believe the dollar is contained, EM becomes pretty interesting. And the yields, relative to high yield, the yields in EM are attractive. So we've cut a little bit of high yield. We've got a good amount of investment grade credit, and we've rotated. So today, I think our average rating is A-, which is pretty good. So it gives us a little bit of room to do some things like EM.
You said something that was interesting there, which is you don't have to go very far out the risk curve in order to get income now because yields are high. Yeah. If the Fed were to cut rates, does that make you more inclined to take more risk?
Yeah, I have to say, for two decades, part of why I'm so excited about where we are today, for 2 decades, it was like, I got to buy high yield at 3.5 and 4, and it doesn't feel natural. But now, if you have the risk-free rate, particularly in the front end here, gosh, I put a little bit of spread on it. Now I get what is ample yield with default rates that are not that elevated. You are seeing some bubbling defaults in a couple of places. So, I think the thing that we would do is, I know what we would do is if rates come down, I'm not a believer, and this is what blows you up. I'm not a believer is, gosh, I got to keep that yield, I got to get my risk up. You just have to absorb it and say, you know what, I'm going to run, I can't run 6.25 or so. I'm going to run 5 3/4 to 6. But what'll happen is the cash rate will come down, and people say, gosh, you know what, cash is only getting me 2.5 to 3. And inflation, even if inflation's 3, it's still pretty good.
Okay. Very few people on Wall Street, though, are saying, you know what, I can just live with less income. It's okay. I won't stretch too far. I'll be disciplined, and maybe I'll just take less cash and I'll commit to the economy. At what point can you imagine that things start to get a bit excessive, especially given the fact that there is a lot of cash right now looking for a home?
So, by the way, it's a funny thing as you say that. We live in a competitive environment. We can't just sit back. It is a tough business, and we have competitors and people that are out there say, gosh, I can get you more yield. Listen, I think one of the things you have to do is you got to keep your volatility. As long as you always think about what's your yield per unit of volatility. Today, I think equities are still going up 15 to 20% from where they are over the next year. So I'm just trying to keep our volatility at a reasonable place. What is excessive? There's some things that are bubbling in the markets that are mostly in privates that are, gosh, I don't get any cash flow for 2 or 3 years. What's the multiple you put on that? That stuff is hard. There are some really good business models. You say, I see it, and it's almost definitional. You see some parts of it where people have stretched. and in some of the credit markets where some of the levels get aggressive. It's part of why we've rotated some of the investment grade. It doesn't do that much for us anymore at those spread levels. But I don't see, like, you saw before the financial crisis, excessive low covenant or easy covenants, high LTV financing. I don't see that yet today. Around the edges a little bit, but not really.
15 to 20% on stocks.
Yeah.
Another double-digit year.
Jonathan, I think we're living through history because, what you asked about before, because productivity and ROE is so spectacular. And by the way, I don't think it's 500 stocks. I think it's, by the way, we heard a stat yesterday, if you take the S&P 1500, is this right that I heard it was 22% off the highs? I thought that number, Russ Costridge, to work with, I thought that was extraordinary. If you take the highest ROE businesses, let's say it's 30 stocks, 50 stocks, tech, healthcare tech, some of the financials, they're doing really well. They throw off a lot of earnings. Their ROE is high, and they buy back huge amounts of stock. Small cap, don't really know. But there's enough stocks with enough market cap that I think will get you that sort of return.
Stay with market weight on the S&P 500.
No,
Embrace
we're long.
the concentration.
We're long. We've reduced a little bit of beta. When equity volatility picks up, I have to bring my beta down a little bit, but I'm still running long. And, days like yesterday, single name, we get these earnings reports, and single name vol is high because, if companies don't hit these excessive numbers, they hit the stock.
Yeah.
So you can still do some things to protect some downside. And by the way, interest rates, if you believe the Fed is moving, albeit deliberately, interest rates actually act as a reasonable hedge again. So there's some correlation to rate that's allowed us to run a moderate long.
Rick, it's good to see you.
Thanks for having me on.
Come back soon. We appreciate it, sir, and best of luck with the process. I've known you a long time. BlackRock wins either way.
Oh, thank you, sir.
The country wins either way. Thank you, sir. BlackRock's Rick Rieder.